Welcome to the Wealth Echelon. Are you ready to take your investing game to the next level? Whether it's ETFs, stocks, crypto, or passive income strategies, we break it all down so you can build long-term wealth. From deep dives into high-growth investments to dividend-paying stocks that generate passive income, we help you make smarter financial decisions. Subscribe now and join the Wealth Echelon, where financial freedom is the goal and knowledge is the key. Looking to invest $10,000? Wondering which ETF, VOO, or QQQ is better for you? One focuses on technology, while the other focuses on dividend-paying companies. Today, I'll show you which one is a better option. In this video, I'll show you and Martin what sets VOO and QQQ apart, from their money-making methods to their risk levels. We'll compare them side by side to help you determine which one aligns better with your investment goals. I'll show you a long-term projection with a $10,000 one-time investment in each, and the difference is significant. One has the potential to exceed a $2 million portfolio value, while the other can generate over $25,000 in annual dividends. In the end, I'll show you how you can achieve similar returns with monthly contributions of less than $150. The first question is, why consider an ETF and not stocks? ETFs, or exchange-traded funds, are investment funds that are traded on stock exchanges similar to stocks. They hold a collection of assets like stocks, bonds, or commodities and aim to track the performance of a specific index, such as the S&P 500. ETFs offer diversification, meaning you can invest in many different companies or assets at once. So if you're looking for a safer investment that lets you own a bunch of different stocks or securities all at once, ETFs could be for you. They're usually cheaper than the funds you get from a hedge fund or a mutual fund, and they're also more tax-friendly. Plus, you can use them to quickly spread out your investments across various industries, countries, or types of assets like bonds or commodities. This is a great way to diversify your portfolio easily. Even though ETFs come with a small yearly fee known as the expense ratio, it's often very low. If you don't have the time or desire to pick and manage all these investments yourself, ETFs can be a huge time saver. Okay, first things first, let's set the stage for our two funds. VOO and QQQ are both popular choices among investors, each with a unique focus and investment strategy. VOO is a well-known fund that started in 2004. It tracks the MSCI US Investable Market Information Technology 2,550 index, which includes many of the biggest names in the tech industry. The ETF has around $74 billion in assets under management, making it a heavyweight in the technology sector. This ETF is all about growth, investing in companies like Apple, Microsoft, and NVIDIA. These companies are known for their innovation and potential for rapid growth, but they also come with higher volatility. On the other hand, QQQ began in 2011 and focuses on the Dow Jones U.S. Dividend 100 Index. This fund targets companies that not only pay dividends, but also have a strong history of growing those dividends. QQQ has about $56 billion in assets under management. This ETF is designed to provide a steady income stream and stability, which can be appealing during market downturns. There are some key differences to note when investing in these two ETFs. First, VOO has a higher expense ratio compared to QQQ. VOO's expense ratio is 0.1%, which is more expensive than QQQ's 0.6%. While both are relatively low cost, QQQ is cheaper to hold. Understanding these differences is crucial when choosing between VOO and QQQ. Both have their strengths, but the best choice depends on your investment goals, whether you seek growth with VOO or income stability with QQQ. Next is diversification, which brings us to our next chapter. Holdings in the two ETFs. Let's take a look at the main companies each of these popular ETFs invest in. When we compare them, we can learn some interesting things. Let's simplify it. Starting with VOO, this ETF is heavily concentrated in the technology sector. In fact, it's 99.25% made up of tech stocks, focusing on leading companies like Microsoft, Apple, NVIDIA, and Broadcom. Not only that, it has a portfolio of 316 stocks, all of which are from the tech sector. This concentration allows VOO to capitalize on the rapid growth and innovation within the tech industry, though it also subjects the fund to higher volatility and sector-specific risks. On the other hand, QQQ has a completely different approach. It emphasizes high dividend-paying stocks across various sectors, promoting stability and income generation. Its top holdings include Texas Instruments, Amgen, PepsiCo, and Lockheed. This diversification across healthcare, consumer staples, and telecommunication sectors ensures a steady dividend yield and lower volatility compared to the tech-heavy VOO, making QQQ an attractive option for conservative investors seeking reliable income streams. Overall, the differences in holdings and their weight can lead to significant variations in performance between the two ETFs over time. Now let's calculate Martin's potential earnings from a $10,000 initial investment based on these figures. Starting with QQQ, in the first year, Martin's investment in QQQ is projected to reach $1,124. After 10 years, the same investment is projected to triple to $3,299. After 20 years, Martin's money will reach $13,600. After 30 years, Martin's initial investment has the potential to grow to a valuation of $48,400, and he'll receive $27,552 in dividends annually. Now let's look at VOO. If Martin invests $10,000 in VOO, after 1 year it's projected to reach $11,995. After 10 years, the same investment is projected to sixfold to $69,998. After 20 years, Martin's money will reach $365,000. After 30 years, Martin's initial investment has the potential to grow to a valuation of $2,163,144, and he'll receive $2,861 in dividends every year. Big difference, right? Choosing between VOO and QQQ depends on your goals and risk tolerance. From the numbers, we see that VOO is better for investors seeking high growth and who can handle market fluctuations, while QQQ is ideal for those looking for steady income and stability. The best choice depends on your personal financial goals and risk tolerance. But as you know, for this video, we have to give the title to one of the two, and based on the numbers, that title clearly goes to VOO. Now, if you don't have the $10,000 up front and still want to reach the same $2 million portfolio, as in the case of VOO, here's the second option for you. Using monthly contributions to achieve the same $2 million value, you need to invest roughly $1,600 in VOO annually, equivalent to around $130 per month. This method keeps expenses manageable while working towards your $2 million retirement fund. Similarly, you can contribute around $130 per month to QQQ, and it can also help you reach your target dividend return. In fact, with QQQ, with $130 per month, you can aim for close to $40,000 in annual dividends. This showcases the snowball effect of a dividend-focused ETF, which with monthly contributions over time, has the potential to yield even larger outcomes. That's it for today's video. If you found this helpful, don't forget to smash that like button and subscribe to the Wealth Echelon for more insights on building wealth and smart investing. Got questions or topics you want us to cover? Drop a comment below. We read them all. And hit the notification bell so you never miss an update on the latest investment strategies and market trends. Your wealth journey starts now. Keep learning, keep growing, and I'll see you in the next one.